My name is Bobby Hapanowicz. I'm from Hapanowicz Associates. We are a wealth management firm that has been helping Verizon employees with their retirement planning for over 20 years. We've helped hundreds of Verizon employees across the country plan for, transition into retirement, and then ultimately implement their retirement plan. And that's exactly what we want to talk about with you here tonight. Many folks know that retirement planning is very important, but at the same time, they may not know where to start. And so that's exactly what we're going to talk about tonight. We're going to talk about the things that you can be doing today, given where you are in your retirement timeline, to be successful in preparing for and transitioning into retirement. But before we do that, a couple of housekeeping items that we want to address. First and foremost, want to inform you that Hapanowicz Associates is not affiliated with Verizon. We are not affiliated with the CWA, the IBEW, or any other union. We are a third-party company. That is actually a good thing. That's a benefit to you that allows us to continue to work with you when you are retired as well. Also want to point out, we have folks who are attending this webinar from across the country tonight. And if we are referencing any specific information regarding your benefits, be it the 401k, healthcare benefits, etc., we are doing so using the Mid-Atlantic East Associates summary plan descriptions. We think it's a very important step that when you are thinking about your planning, thinking about your benefits, that you always start by reviewing the rules within your summary plan description if you are from another region of the country as well. And we can help you do that. One more thing, want to make sure that everybody here is familiar with the Retirement Red Zone. That's an online resource that we have created specifically for Verizon employees, regardless of the phase of career that you're in, whether you're in the middle phases of your career, close to retirement, already retired. There's going to be a lot of information there about your benefits and the planning process that will be very helpful to you. You can see the link there. You can also just Google Verizon retirement planning and you'll find the Retirement Red Zone. So let's get right into it. What are we going to be covering today? Well, again, we're going to talk about that checklist of items that we think you need to be addressing if you're going to be retiring within the next 5 years. Starts with your 401k. Investing in your 401k for retirement versus investing it for growth. Next, we'll talk about retirement income planning. We'll talk about debt paydown strategies to control expenses. We'll talk about your retiree healthcare benefits, very robust benefits as Verizon, union affiliated Verizon employees. And then ultimately, we'll talk about monitoring pension lump sum interest rates. And then on the right-hand side, you could see the time frame during which we think you should be addressing each one of these items in your retirement planning timeline. Finally, we'll be answering your questions. Some of you have submitted questions ahead of the webinar. We thank you for that. If you have any other questions, just use the chat box, use the Q&A box here on the screen. Okay, let's start with investing your 401k for retirement. And we have this first because we think this is the first thing, regardless of what stage of career that you're in. This is one of the most important, if not the most important thing that you can do to plan for a successful retirement is address your 401k. And when we think about 401k investing advice, the traditional advice has been to set it and forget it. And that advice is directionally correct, right? That broadly speaking, that is correct. But for a couple of nuances, one of which are unique to Verizon employees. That first nuance is that the employer match that is made available to Verizon employees has traditionally been invested automatically in Verizon stock. And that has been that way. It was that way prior to February of 2021. Since then, that rule has stopped. But before that date, any employer match that was contributed to your 401k was invested automatically in Verizon stock. And so if you're somebody who hasn't looked at your 401k allocations in 5, 10, 20 years, that can mean you are excessively concentrated in Verizon stock. That can add unneeded risk to your 401k. So if that's you, if you haven't looked at your 401k allocations in a long time, please make sure to take a look at that and confirm that you have the amount of Verizon stock in your 401k that you intended. The second issue with that traditional advice is a little bit more related to what we're talking about here today. And that's that your investment plan should evolve as you get closer to retirement, right? The game plan that made sense for you in the first 25 years of your career may not make as much sense over the next 5 years of your career as you're transitioning to retirement. And so what do we mean by that? Well, let's talk about investment allocation considerations that you should be keeping in mind, generally speaking. If you're thinking about, how to allocate your 401k, how much stocks versus how much bonds should I own in my 401k, there's really three key considerations that you should be thinking about. Number one is how much income do I need? Number two is how long do I have until I will be using my assets for income? And number three is what is my comfort level with risk or volatility with my investments? And to the extent that you don't need much income, you won't be needing much income for a very long time, and you are comfortable with risk, that tends to lean more towards a growth-oriented allocation, meaning you'd own more stocks in your 401k. And that's what we see in the early to middle phases, how folks who are in the early to middle phases of their career investing. As you get closer and closer to retirement in the later phases of your career, well, now you start to foresee a day that you will need income. That day is approaching closer and closer. And as that happens, our risk tolerance tends to decline. We tend to be less willing to accept volatility in our 401ks. And so with that said, we go from prioritizing long-term growth to having more of a balanced priority between long-term growth, between current income, and between volatility management, right? In retirement, we're still long-term investors. We're going to be using this money to create income for 30, 40 years. So we need this money to continue to grow in a way that allows us to maintain our purchasing power with inflation over time. But with that said, we're still using this money for income today. So current income and thus the ability to manage volatility through asset allocation is important. So, as you glide path to that retirement-like allocation, you're glide pathing to more of a balanced allocation generally between stocks and bonds. We believe that glide path shouldn't happen all in one day. It should happen gradually over time as you get closer to that retirement date, starting, 5 to 7 years away from retirement. So let's talk about the investment options that are available to you in the 401k, right? So you have target date funds. And what are target date funds? Target date funds are a hands-off approach to investing. They are well diversified for you. They are managed professionally by professional managers. And what they do is they glide path you from a growth-oriented targeted allocation to a retirement-like allocation by the target date. So what do I mean by the target date? Well, when you look in your 401k investment options, you'll see these target date funds with different dates on the fund, 2030, 2035, 2040. Well, that date is the target retirement date, and they are glide pathing you to a retirement allocation by that date. So again, really good hands-off approach to investing where professional managers are making the decisions for you in a way that is generally suitable for folks who are at or around your age. Next category of investment options available to you in the 401k are your risk-based options. So instead of investing with a date in mind, like with the target date funds, these funds are invested with a targeted risk level in mind. So again, these funds are also professionally managed. They take care of diversification for you. And there are 5 different levels of risk that you can undertake with these risk-based options, ranging from conservative, which is 0% stocks and 100% bonds, to aggressive growth, 100% stocks and 0% bonds. And there are 3 options in between as well. Finally, you have asset class options, and they allow you to invest in specific asset classes across the globe. For example, what is an asset class? Large size US companies are an asset class, right? Like the S&P 500, that would be considered an asset class. US bonds are an asset class. International stocks, small size companies. These are all different asset classes. And with these asset classes, you can create a portfolio that is specifically customized and tailored to your needs. So with these different investments that are available to you in the Verizon 401k, you can implement your own glide path from a growth-oriented allocation to a retirement-like allocation. And again, we think this should happen not overnight. This should happen over the course of 5 to 7 years. You might have 2 or 3 or more legs during which you de-risk to a retirement-like allocation. And you can do that in a couple of different ways. Number one, if you want that hands-off approach, you might use a target date fund. Again, these target date funds will automatically glide path you to that retirement-like allocation. The drawback to using the target date fund is it's a cookie cutter approach. It's not specific to your situation, right? When you use the risk-based asset allocation options, the risk-based options and the asset allocation options to implement your glide path to a retirement-like allocation, this does require more attention. But with that said, you can create an investment plan that is tailored to your specific income needs, timeline, and risk tolerance, right? So again, you can use a hands-off approach with target date funds, or you can use a more customized approach with the other investment options available to you. I want to point out that we at Hapanowicz Associates help Verizon employees with their 401k allocations. We provide this service free of charge, free of obligation, and we can consult with you on the right 401k investing game plan, should that be beneficial to you. Okay, next phase of your retirement planning is to actually begin building out your income plan. And when folks think about retirement planning, this is oftentimes the step that they are visualizing in their head. We think this step should start 2 to 5 years before retirement. Many folks start thinking about this. Common mistake that we see. Many folks start to think about this right before they want to retire. We think this process should start at least a couple of years prior to retirement. And why is that? Well, number one, it helps you gauge your retirement readiness, right? Can I retire on the timeline that I want to with the lifestyle that I envision? Number two, it gives you time to make any necessary changes, right? Do I need to contribute more to my 401k, change my 401k asset allocation? Do I need to manage expenses differently, right? These are different changes or adjustments that the retirement income planning process can help you identify. Number three, having a plan in place makes it easier to adjust for any unforeseen changes, right? For example, early retirement offers. Right? When you have the plan in place, it makes it a lot easier to consider an early retirement offer. Oftentimes, when these offers come out, they give you 30 to 45 days to decide if you're going to take that offer. Having a plan in place first allows you to digest that information much more effectively and make a really good decision. So let's talk about how to construct your retirement income plan at a high level today. And that process begins with your vision, right? What do I want to pursue in retirement? This is a really important step. This is maybe the most important step in your retirement income planning, because this is what makes your plan unique to you. What do I want to accomplish in retirement? Right? For different individuals or families, that can mean different things, right? Some folks want to travel more or spend time with children or grandchildren, maybe take up a new hobby. Whatever that might be, that vision is ultimately what we are going to use, though, to determine the success in your plan. That's what we are solving for in your plan. That's our North Star. So from a qualitative standpoint, again, that's what we want to accomplish. Understanding your vision is very important. From a quantitative standpoint, that can also be very helpful in helping us with the next step, right? What are your expenses going to be in retirement? How do we determine what your expenses are going to be in retirement? Well, we'll start by understanding what your current expenses are. Then we'll look at how those expenses can change or evolve in retirement. And, inflation is one consideration that you should keep in mind, right? If you're completing a car payment or a mortgage, that expense could drop off in retirement. Pursuing your vision is another thing that could change your expenses in retirement. If you want to travel more in retirement, if you want to move south, whatever that vision is, we need to account for those expenses or the anticipated change in your expenses in the income planning that we're doing. Next step in the retirement planning process is continuing to take your personal inventory, yet on the other side of the ledger. Right now, we are accounting for assets and income sources that could be used for income in retirement. So what are some common income producing assets that we see Verizon employees having? Well, your 401k is one income producing asset. Your pension, if you are taking the lump sum option, is an asset that you can use for income, right? Other retirement accounts, traditional IRAs, Roth IRAs, taxable investment accounts. If you have a brokerage account that has different tax treatment than retirement accounts, that is another valuable income producing asset potentially. Investment real estate, if you're collecting rent for any investment real estate property that you have, that could be an income source in retirement, an asset that could produce income in retirement. And then we also look at expected inflows, expected income sources that you'll enjoy in retirement. Social Security security being a key one. If you take the annuity option with your pension at Verizon or another pension, that's not necessarily considered an asset on your balance sheet, but that's an income source that you can expect to receive over the course of your retirement that should be incorporated. Right. Any part-time work that you may want to do, whether it be at the local golf course, at the grocery store, wherever that might be, that part-time work can be considered as an income source in your retirement planning. And so what we do is we take inventory of all these things. We help you see what potential income could look like for you to meet your expense needs throughout the course of your retirement. That's sort of what you see on the right-hand side of your screen. In this retirement income planning process, matching income with your income needs help us generate insights that are important for you, right? Some of the most common questions that we see folks asking when they begin the retirement planning process are, how much can I spend in retirement, right? How will adjusting my retirement date affect my financial outlook? How much additional budget for vacations can I afford, right? Going on down the list, when should I elect Social Security? These are all really important questions that folks have when it comes to retirement income planning, and putting that foundational plan in place is a really important step for you to determine the right answer to the question for you. For each one of these questions, the answer for you will be a little bit different than anybody else. And so with that said, the retirement income planning process can be a complicated process. There's a lot of moving parts, a lot of considerations to keep in mind. And so with that said, we want to include a couple of tips that we think that you ought to be thinking about and considering when you create your retirement plan. Number one, we think you should be thinking about your expenses comprehensively. This includes taxes. This includes the cost of retiree healthcare benefits. Those two items oftentimes are overlooked in the planning process, but they're very important. They're real expenses. And ultimately, you need to be thinking about how your expenses could potentially change over time. Second tip, make sure that you're accounting for inflation, right? Retirement could be a 30, 40-year long period or more. And over that time, inflation can erode your purchasing power if you aren't considering it and if you aren't investing in a way that can allow your money to grow with inflation and allow your income to grow with inflation. Number three, it's important to plan for longevity. This stat is really interesting and can be very surprising to a lot of people. According to the Society of Actuaries, they recently did a study in the past couple of years. A 65-year-old couple has a 50% chance of at least one member of the couple living into their early 90s and a 25% chance of one member living into their late 90s. So it's very important that we are planning on longevity. That leads to the fourth tip. It's important to be prudent and be conservative with the assumptions that we are making. That means we want to make sure that we see the plan last for a very long time. That also means that we're conservative with the investment growth assumptions that we are making, right? If your investment portfolio has an expected rate of return of X, it might make sense to use investment growth assumptions that are lower than that number to make sure that we're setting you up for a positive surprise in retirement, right? When we're planning over the 30 or 40-year period of time, being prudent with the assumptions that we make is important. Make decisions comprehensively, not in a vacuum. What do I mean by that? Well, any decision that you make, right, whether it be Roth conversions, whether it be when to elect Social Security, whether it be take the pension annuity or pension lump sum, these are all interrelated. And what you do when you elect Social Security may have an impact on what you do with Roth conversion planning or tax efficiency planning, et cetera. All these things are interrelated. So we encourage you to think about your planning comprehensively and not think about these decisions as one-offs in a vacuum. Finally, maybe most importantly, is to continue to monitor and update your plan over time. These plans should not be set in stone. These are living and breathing documents. We know that life changes, right? Life will change leading up to retirement, and retirement is a very long time, right? And so as life changes, it's important to continue to monitor and update your plan to make sure that it continues to reflect where you are today and your goals and vision for your future. Okay, step number three, this sort of dovetails from retirement income planning, and that's creating a debt paydown plan. This is a very important step that you can take because it can help you control expenses. If you implement a debt pay down plan while you are still employed at Verizon and you are able to pay down debt quicker as a result, this All else being equal, this means that you'll need less retirement savings to support your lifestyle, or that can mean that you will be able to retire sooner. So let's take a very simple example. Let's say somebody has a $7,000 in monthly expenses. Okay. But now let's say that 3,000 of that $7,000 is debt payments. Well, if we implement a debt paydown plan that can help you take control of those debt payments and complete them, ultimately complete them sooner than you otherwise would, well, then now after you've completed those payments, your expenses went from $7,000 to $4,000. It takes less saving, it takes less time to be able to create a $4,000 income stream in retirement than it does to create a $7,000 income stream in retirement. And that's the power of considering a debt paydown plan and incorporating this in the retirement income planning work that you do. So again, we have on here that this could start 2 to 5 years prior to retirement. Really, the sooner you're able to start with this, the more time you have to make those constructive changes. So we encourage you to think about this. Of course, there is such thing as good debt, right? And there's a difference between good debt and bad debt. What's an example of good debt? A mortgage, for example. As you pay down your mortgage, you're building equity in your asset, in this case, your home. And many of you on the call may have refinanced your home. Maybe that made sense for you, maybe it didn't. You may have refinanced your home 3-4 years ago during COVID when interest rates, mortgage rates were less than 3%. If that was you, that's a form of good debt, right? The interest rate is very low and it allows you to build equity in an asset. There's not so debt too. There's bad debt as well. For example, excessive credit card debt can be a form of that. Consumer debt, credit card debt. Oftentimes credit card debt can carry an interest rate as high as 30% or more. And so that's an example of that we want to prioritize paying down, particularly before retirement. So how can we do that? Well, there's a few different ways that you can consider paying down debt, right? There's the traditional approach, which can make sense for certain individuals, right? And that would mean that you're completing the payment with the highest interest rate before moving to the next, right? So if you have a credit card that has a 30% interest rate and you have a car payment that has an 8% interest rate, regardless of what the balance is on the credit card versus the car, you would, in this case, pay the credit card down first because it has the higher interest rate. So what is the advantage to taking this approach? It can reduce the overall interest paid because you are paying down the balance of the higher interest rate debt first, right? The disadvantage of this is that the progress can feel slow if you're continuing to chip away at high interest rate debt that has a large balance. You're continuing to make payments on that, and the progress can feel slow. It can feel like you're not making up ground, even though you may be making up ground. The second option available to you is what's known as the snowball approach. And with the snowball approach, the interest rate on the loan would be secondary. The first thing that you would look at is the size, the balance that you are carrying in that debt, right? How large a balance is the debt? You would start by paying off the smallest payment first and then making minimum payments on the others. So actually have an example to run through here. This graphic explains what the snowball approach might look like. So in this case, we have 4 debt payments. The first payment, debt payment number 1, the minimum payment is $30. Number 2, the payment is $75. Number 3, the payment is $150. And debt payment number 4, the payment is $200. And so this person has $45 in extra cash flow that they have available to make towards debt payments. And so instead of spreading that $45 of extra cash flow across all 4 payments or putting that on the largest payment, they're going to concentrate that on the smallest payment. And you can see there's a balance of $300 here. They are making payments of $75. And because they are making $75 payments on that debt, larger than the minimum payments on that debt, they're going to pay that off quicker, right? So it'll take 4 months to pay off that $300 balance with $75 monthly payments in this simple example. And once that payment is completed, well, they have $75 of freed up cash flow. So what did they do next? They add that freed up cash flow to the next debt payment, right? So instead of making $75 minimum payments, they're adding the 75 from the prior payment to this payment as well. And now they're making $150 per month payments. And now, because they're making a larger payment, they're going to pay off that debt quicker. Once that debt is paid off, they're able to roll over that cash flow that was going towards debt payments number 1 and 2 into debt payment number 3. Once debt payment number 3 is paid off, cash flow from debt payments numbers 1, 2, and 3 can be rolled over into number 4. And so in that way, the advantage to this is momentum, right? You feel the momentum of completing one payment over the next, and that can help you with the implementation, right? That can help you with actually executing the plan. Right. Of course, the disadvantage could be that you could pay more interest over time. If the larger outstanding balances have higher interest rates, you may pay more interest over time. That's the disadvantage. But again, that momentum can be a very powerful motivator. The third option available is a debt consolidation loan. So you could take out a new loan or other form of credit to pay off multiple existing debt payments. And so that could be a debt consolidation loan. That could be transferring your current credit card balance to another credit card that may have a temporary 0% interest rate. As another example, if you have higher interest rate debt that you can consolidate into a lower interest rate consolidation loan, that can reduce the total amount of interest that you pay over the lifetime of those payments. Let's head into the fourth consideration that we think you should be keeping in mind, and that is considering your retiree healthcare benefits. And again, this is another overlooked topic, yet it's a very important topic in your retirement planning. If you're a CWA affiliated Verizon employee, you have access to robust and cost-effective retiree healthcare benefits package. And as a matter of fact, many of you on the call today are considering a retirement prior to the age of 65. And in large part, that's possible because of the wonderful retiree healthcare benefits that have been negotiated on your behalf. Without those benefits, it might not be possible for many folks to pay COBRA costs prior to age 65, prior to enrolling in Medicare at age 65. So with that said, it's important to ensure that the coverage that you have today during your career is right for you. And we'll go through the considerations that we think you should be keeping in mind in order to do that. But first, let's start with a summary, the coverage that's available to you as a retiree. So, of course, as an employee of Verizon, you have access to medical, dental, and vision coverage. You have access to the same medical coverage and dental coverage, for that matter, in retirement, as long as you're retirement eligible as a CWA affiliated Verizon employee. You have access to the same medical and dental coverage while retired that you do while employed. You have a vision plan that's available to you, the Davis Vision Discount Program. That's available to you in retirement. So your vision coverage drops off, but you have access to the Davis Vision Value Advantage Program or discount plan. And so there are participating stores or locations across the country that participate in that program. And if you use one of those, you can get a discount, right? But one thing that we encourage folks to do if they are going to be retiring soon is to make sure they get their vision checkup, their eye checkup before they retire, because otherwise it won't be covered. Okay, let's talk about spouses coverage, right? So spouses and dependent children's coverage. So spousal coverage in retirement is identical to coverage when the associate was employed by Verizon, right? So you can have coverage under the associate's benefits. For dependent children, your medical coverage can continue up until age 26. It terminates the first month after you turn 26. So today's May 21st, if today is your dependent child's birthday, they're 26 years old. Next month, June 1st, they are off your coverage. Dental coverage for a dependent child will continue up until age 25 as long as they're a full-time student. That could be undergraduate or graduate student. Up until after age 25, the dependent would lose dental coverage the year after they are no longer. After age 25, they would lose coverage, and the dependent would also lose dental coverage the year after they are no longer a full-time student. Otherwise, the dependent child would lose dental coverage at age 19. Let's talk a little bit about what happens to a spouse's benefits or dependent's benefits if the retiree were to pass quickly. Verizon will cover medical insurance premiums for 12 months after the death of a Verizon retiree. Near the end of that 12-month period, your spouse would receive a letter letting them know it's time to start paying for coverage as a surviving spouse or dependent. At that time, they would have COBRA costs. And the premiums at that time would be significantly higher, likely significantly higher than what the spouse would have enjoyed while the associate was alive and they were on the associate's retiree healthcare benefits. And so those costs could be as much as $1,000 a month or more. The pre-Medicare plans, it could be $211 a month for the Medicare Advantage plan. And dental coverage ends at the end of the month in which the retiree passes as well. So these are the different medical coverage options that you have available to you as a pre-65 Verizon retiree. The Blue Cross Blue Shield Anthem plan, the Managed Care Network plan, any PPO plan, the HMO ETO plan. And retirees, it's important to note for planning purposes that retirees are highly likely to have different healthcare coverage costs in retirement than when they were employed. And those costs have continued to increase for retirees. If you are speaking with any of your former coworkers who are retirees now, you may have heard about the rising costs of healthcare premiums that they are experiencing. And it's all the more important reason that we incorporate that in your retirement plan. So post 65, if you're a retiree post 65, you would enroll in Medicare, and the CWA has negotiated terms with United Healthcare Medicare Advantage plan. Those terms continue through the end of 2026. And the terms are very favorable for you. You have no monthly premium costs. You have a maximum annual out of pocket, $1,050. And again, those costs, for how robust your plan is, those costs are extremely competitive. We always encourage folks to shop the marketplace if they want to. With that said, those costs are very attractive. Typically, no premium plans may have a maximum out of pocket that are closer to $8,000 to $10,000, if not more. So again, very competitive plan. So with that said, with that summary, that brief summary of the retirement benefits available to you, let's talk about some of the considerations that you should be keeping in mind when determining if the health care coverage that you have today is right for you and your family in retirement as well. So, is my coverage sufficient today? Is it meeting my needs, right? Will your lifestyle be changing in retirement? Will you be traveling more? Some of these plans work really well within a network, within a certain region, and don't work well outside of that network or region, right? Speaking of network of professionals, do I or my spouse have any medical conditions that will require an out-of-network specialist? Again, if you do, then you'll want to make sure that you are keeping that in mind when selecting your healthcare plan. And so the last consideration that we have here is costs. And we have that last because it's important, but we also need to make sure that all these other factors are addressed first, and that ultimately we need to make sure that you're choosing the right coverage option for you and your family. And then after we've done that, costs become a factor. And so, with all that said, we think that these consideration should start to be addressed 1 to 2 years before retirement as part of the planning process that you're otherwise going through. So, for more information, you can always log on to your online portal, VerizonBenefitsConnection.com. If you want to see what retiree healthcare costs would be this year, if you want to see the different features available within each plan, you can find that there. For more specialized help, we'd encourage you to reach out to Tom Ballack, the CWA Retirement Benefits Specialist. Be sure to take down that name, take down that phone number. If you need it after the webinar, we'd be happy to follow up and provide that to you. Tom is a wonderful resource. He's helped us with our understanding of these benefits as well. He's always open to retirees or pre-retirees reaching out with questions, so make sure to leverage him as a resource too. Okay, finally, let's talk about monitoring pension lump sum interest rates. This is the final consideration that we think you should be planning around here that we're going to discuss today. So many of you are familiar, if you're considering the pension lump sum option, that the pension lump sum is interest rate sensitive, right? There are different interest rates that can impact the value of your pension. So there's the GAT rate, which is tied to the 30-year Treasury bond. There's the PBGC rate, which uses up to 4 different interest rates, 1 immediate rate and 3 deferred rates. And the PPA rate and the 10-year rate have been less relevant in recent years. The GAT rate and the PBGC rate have typically resulted in the largest pension lump sum calculations. Your pension lump sum is calculated quarterly as an associate, monthly as a manager, and whichever one of these interest rates results in the highest highest lump sum calculation is the one that is used for your lump sum. And so what is the relationship between interest rates and lump sum values? Well, it's an inverse relationship. It's a seesaw relationship, right? As interest rates go down, lump sum values have gone up. And that's the trend that we saw really over the last 40 years, starting from around 1980. Through the 80s and 90s, 2000s, 2010s, we've seen interest rates generally decline. And because of that, by 2020, 2021, we saw pension lump sums reach historically high levels. And since that, we've seen the reverse happen. As the Federal Reserve has increased interest rates to combat inflation, that has caused a trickle-down effect on interest rates throughout the economy, including your pension lump sum interest rates. And so with that said, as interest rates have gone up over the last couple of years, your lump sum values you will have seen have come down as well. And so here's a table that shows the potential impact that a change in interest rates can have on your lump sum value. With that said, a very common question that we get, a question that we got over the last couple of years as we saw interest rates creep up and lump sum values thus creep down, is should I retire early to lock in lower interest rates and thus a higher lump sum value? And the answer to that is it can be helpful to start monitoring interest rates within about 1 year of retirement, right? So if your target retirement date is a couple of months away and we see that interest rates are likely to change next quarter, we're going to have a conversation with you and we're going to discuss what that change in interest rates, what effect that can have on your lump sum value. And we're going to discuss if that can make sense to bump up your retirement date a few weeks or push it back a few weeks so that you could take advantage of the best interest rate, lump sum interest rate to maximize your lump sum value. But if you're more than 1 year away from retirement, there are many benefits to staying employed that can overshadow any changes in the pension value. For example, if you're earning a salary, right, that's $80,000 to $100,000 a year that you could be earning, that can more than offset the change in direction of pension lump sums due to interest rates, right? Over that time that you're earning a salary, you can be contributing to your 401k. Verizon will match 5% of the first 6% that you contribute to your 401k. Your 401k can continue to grow over time before you ultimately start using it for income. The longer you wait to retire, the more high income earning years. For most of us, our highest income earning years are concentrated in the latter part of our career. The longer you wait to retire, the more high income earning years go into our Social Security benefit calculation. And that'll mean a larger Social Security benefit for you. And so these four factors and more can more than overshadow any change in pension lump sum values if you're 18 months, 2 years, 3 years or more away from retirement. And so, that's why this is the last consideration that we think you should be keeping in mind. It's every bit as important as the rest. We want to see you maximize the lump sum value of your pension if you're considering that lump sum option. But first and foremost, we need to make sure that we are checking off all the other boxes, right? We're investing our 401k well. We've done our retirement income planning and know that we can retire on the timeline that we want to. We've done the other things like consider a debt paydown plan, like consider our retiree healthcare benefits to make sure that we are ready to retire. Once we've done those things and once we are very close to that retirement date, then, those changes in lump sum values that we want to make sure that we are maximizing the value of that lump sum benefit by monitoring interest rates. So as we conclude here today, I want to bring back the first, introduction page that we looked at to summarize the different areas that we think you should be addressing if you're within 5 years from retirement, right? Really, it starts with your 401k, and this can start much sooner than 5 years from retirement. But once you're 5 years away from retirement, you should be looking at that glide path process of glide pathing from growth oriented to retirement oriented in your 401k. If you're 2 to 5 years away from retirement, you should begin the retirement income planning process. This process will help you articulate your vision on paper. It will help you determine your retirement readiness, and it will help you take any changes, any unexpected changes on the fly. It'll help you react better, more effectively to any changes, right? Debt paydown strategies can help you control expenses in retirement, and they can increase your retirement readiness. Your retiree healthcare benefits can be extremely important. They often go overlooked, but they're an extremely important thing that you should be considering that you should be gathering information around. Finally, once you've done all those things and once that retirement date is right around the corner, less than 1 year from retirement, we think it could be very valuable to monitor pension lump sum interest rates in order to maximize that lump sum benefit, right? And we're going to get into some Q&A. Before we do that, as a thank you to everybody who came on the webinar, we're going to be emailing everybody what we call the Verizon Employee's Guide to Retirement. And what this is it's essentially a timeline that encapsulates these steps, but it also encapsulates the tactical steps that you need to be taking when you decide to transition into retirement, right? When to elect your pension lump sum benefit, when to enroll in retiree healthcare benefits, when to call Fidelity about your 401k. That's all listed in this document along with other best practices. Again, as a thank you for attending tonight, we're going to be sending this document to you. Also want to make sure that everybody's aware that, again, we help Verizon employees with all of these things prior to retirement. We help them and their families free of charge and free of obligation, right? There's no obligation to use us in retirement. There's no obligation to use the planning advice that we give you either, right? We understand that your benefits are unique. We understand that they are complex. And our mission is to make sure that Verizon employees have access to the information that they need to make really good, sound financial decisions. That's what the financial planning process is here for. The retirement planning process is here for, to give you the information that you need. And with our unique experience helping hundreds of Verizon employees across the country, we think we can help you with that. So with that said, if anybody has any questions, happy to address those at this time. Actually, a few of you submitted questions ahead of time. We're going to pull those up and review those here today. So would it be a good idea to move some of my 401k funds into something different, such as an annuity or an IRA? That's a great question. Let's talk at a high level about that, right? Your 401k is designed to be a wealth accumulation vehicle throughout your entire career, right? It's meant to be low cost. It is meant to provide access to, all the basic asset classes that you might need to build wealth effectively over the course of your career. If you want access to a wider array of investment options, if you want the ability to have your money managed for you, then other investment vehicles such as an individual retirement account could make sense in that sense. With that said, annuities and IRAs are both very different investment vehicles, right? An annuity is a type of investment option. An IRA is a vehicle through which you can invest. We believe that the financial planning process tells us how you need to be implementing with investments, right? So let's start with the planning process. Let's start with your vision for what it is you want to accomplish over the course of your retirement. Let's work backwards to what we need to do today to implement that vision through the planning process. And then that planning process will tell us the best way to implement your investment plan, right? Investments are the implementation of your retirement plan. So in order to answer that question best, we would need to have a financial planning, retirement planning conversation, and we're happy to do that. Another question here. What if you are a regular IT employee? Does the CWA benefits apply to you? So the CWA, Communications Workers of America, is a union that certain work groups within Verizon have affiliation with. If you are a CWA represented, then some of these benefits could apply to you. If you aren't, then there could be different benefits that apply to you. Again, we always think it's a good idea to check with HR and to check your summary plan descriptions to determine, what benefits you are eligible for. Again, that's a process that we help Verizon employees with. That's the first step in our process, is to do that due diligence, do that fact finding to make sure that we all have an understanding of what benefits are available to you. Okay, at what age can I access my pension without penalty? It's a great question. We didn't talk about retirement eligibility or pension eligibility today. We covered these 5 topics at a very high level today. For more information, we can have a conversation about any specific questions. You could also check out the Retirement Red Zone, where we have more detailed information on each one of these 5 topics. But regarding pension eligibility without penalties, so you may be aware of the Rule of 75. If your age and years of service add up to 75, you satisfy the rule of 75, and you are retirement eligible. That means you're eligible for retiree benefits, and you're eligible for your pension, your retirement pension. And so let's talk at a high level about how the rule of 75 works. If you are at least 50 years old or older, or at least 50 years old with 25 years of service or more, you're retirement eligible. If you're 55 years old or older and have at least 20 years of service, you're retirement eligible. If you're at least 60 years old and have 15 years of service or more, you're retirement eligible, so on and so forth. The important thing is both of those need to be satisfied. You need to be both older than 50, 55, or 60 and have at least 25, 20, or 15 years of service. So, for example, somebody who's 52 years old and has 23 years of service, they satisfied the age requirement, but they didn't satisfy the years of service requirement of at least 25 years of service. Even though their age and years of service adds up to 75, they're not retirement eligible. If you're retirement eligible prior to the age 55, and this is, I think, specifically what this individual is asking about. If you are retirement eligible under the age of 55, you have an age discount or penalty that is applied to your pension. That penalty is 0.5% per month under the age of 55 that you are. So, for example, if you're 54 years old and you're 12 months shy of your 55th birthday, 12 months times 0.5% is a 6% penalty that's applied to your pension, right? There's one caveat to that rule, and that caveat is if you have 30 years of service. At any time that you have 30 years of service, you're retirement eligible. If you have 30 years of service under the age of 55, there is no discount that's applied to your pension benefit. I know that rule of 55 can be very confusing. We have write-ups available on the Retirement Red Zone and videos in the Retirement Red Zone that address that in a little bit more detail. And happy to circle back and have a conversation with you on that topic as well. We'll be following up with everybody over email. If you have any other questions that you'd like to make sure that we cover with you, happy to have another conversation over the phone or exchange over email. Again, we thank everybody for tuning in with us tonight. Hope this is helpful to you. If you have any questions that are specific to you, we'd be happy to help with those in any way that we can. One other question from somebody here. Did you say you can help and there is no charge? Yes. The financial planning services that we provide to Verizon employees prior to retirement are free of charge and free of obligation, right? Free of obligation to you assist in retirement. We've had a wonderful working relationship with many Verizon employees. We're appreciative of that relationship and want to make sure that current employees have access to the information they need to make good decisions. So that means any 401k reviews and retirement planning work that we do for Verizon employees is free of charge. Okay, hope that was helpful to everybody. Thank you again for tuning in and have a nice rest of your night.